Hey family, welcome back to my channel. My name is Matt. If you're new here, welcome. If you're a returning family member, thank you. Remember to like, subscribe, turn on post notifications, do all that fun stuff. There's going to be a giveaway on this channel soon, so stay tuned to the end for more information about that. And let's get into this video. We're back with financial vocab part number 3. So we're back, we're looking at that stupid bulletin board with the popcorn ceilings. You know the drill, we've been through this. You know, this is a good little series we're going on. I like it, I enjoy it. You know, we're having fun, we're doing our thing. We're gonna have some vocab going today, like the title of the video, so let's get into it. Now, word number 1, dollar cost averaging. Sounds like such a fun word. Now, actually, before we do this, just wanted to let you guys know, this is for entertainment and educational purposes only. This is not financial advice. Obviously, this is really educational today because we're going to go through a bunch of different words that we're going to talk about for finance, and it's going to help you guys understand, because the foundation of understanding how to invest is understanding the vocab before we get started. So we're going through that. So back to it. Now, dollar cost averaging, great way to start off. So we're going to go over the actual definition, then we'll go over my definition. So the actual definition of dollar cost averaging is, dollar cost averaging is an investment strategy that aims to reduce the impact of volatility on large purchases of financial assets such as equities. Now, English please Matt. Basically it means reduce your risk when you're buying into the stock market. Now, how do we do this? On a monthly basis usually, or on a bi-weekly or monthly. Usually monthly is a good way to do it. So, for example, let's say you want to invest $100 a month into an S&P 500 fund, or $100 a month into a growth fund, or in an index fund, right? So you'd have $100 that comes out of your bank account every single month on the 1st, on the 15th, on the 27th. You control which day you want it, all that fun stuff. So basically, the money comes out, goes into the investment, and that's how you build wealth over time with compound interest, because you're putting money in the investment every single month, or every single 2 weeks, or every single paycheck, whatever. You can set it up any way you want. But basically all it means is the money's going into the investment over time, which then therefore compounds and builds and creates a nest egg. Now, next word, nest egg. Basically this is just the amount of money you have in your retirement / your investment / your mutual funds. This could be real estate, this could be gold, this could be mutual funds, this could be single stock, this could be a company, whatever the net worth of the whole nest egg is what you have in your nest egg. Which brings us to the net worth. Now, net worth is a pretty common word. You know, a lot of people throw it around in the financial industry, and we're gonna go over what it means, how to calculate yours, and all that fun stuff. Net worth is the total wealth of an individual, company, or household, taking into account all of their financial assets and liabilities. So you have your assets, you have your liabilities, you know, basic accounting terms. So an asset is something that could produce money or is worth money if you sold it today, or it's cash. And then a liability is something that you owe money on, either a debt or something like of that nature. So basically what we do to calculate your net worth is, let's say you have $10,000 in a bank account, right? Let's keep it simple. And you have $1,000 on a personal loan. So that means you have assets of $10,000. You have a liability of $1,000, so your net worth would be $9,000. So 10,000 minus 1,000 equals 9,000. You have your assets, you have your liabilities, and then you have your net worth. So basically what it is basically all your assets minus everything you owe equals your net worth. It's a very simple formula, and if you do want to calculate it, go ahead, do it yourself, see where you're at, and see where you want to be. So the next word we're going to go over is rebalancing. This usually happens in a portfolio. This is when the rebalancing of investments is the action / trading strategy of bringing a portfolio that has deviated away from one's largest asset allocation back into line. So basically, if your allocation has went off the deep end or changed substantially over the last couple of years, it's bringing it back to where it was originally, or creating a new strategy that you want to invest with and then bringing it back to that strategy. So it's basically that deviated off course, you're at a different place, and now you want to get back to where you originally were, and that's basically what rebalancing investments means. Now the next word is a stock option. What's a stock option? when you go to work for a company, they could give you the option to buy their personal stock at a discounted price. Usually, I think it's 20 to 30%. Do not get fooled though. Usually that's not a great discount, because if you look at the 52-week highs and lows of that stock, usually they'll see it fluctuate about 20%, which boom, that's what the discount is. So it's not really a discount, it's just giving you a little bit of an in because you work for the company. So don't all get excited and jazzed up about stock options. They're good. If they give them to you, great. They don't, it's okay. But it's not gonna get you, you know, it helps you build wealth, it gives you some stock. But remember, you usually have to buy it, first of all. And second of all, usually it's not any cheaper than just buying it on the regular stock market, you know. So don't get caught up in stock options. But basically it's just the company that you work for giving you the option to buy stock at a discounted price. That's all it is. And then the last word, roller coaster, my favorite. Now, is this really an investment term? Not really. But basically the stock market is a roller coaster. So basically what you gotta do is you gotta go with the ups, you gotta go with the downs, you gotta go with the highs, you gotta go with the lows. You can only get hurt when you jump off the roller coaster. Just don't jump off the roller coaster and you'll end up in a nice, cushy place with a nice beach view and a little bit of money in your pocket. Nice place to be. So remember, $100 Visa gift card giveaway on this channel. Remember to like, subscribe, turn on post notifications, do all that fun stuff. I very much appreciate every one of you for watching, clicking on videos, and supporting me and all that fun stuff. Remember to go follow me on Instagram. You know, family's growing over there, and we'll get to 1,000 family members, and we're just gonna keep going, guys. Chugging along, doing our thing. I want you guys to become the best version of yourself. I want to become the best version of myself. Get your true potential out of you, you know, let's do it. You know, I want to help you guys in any way I possibly can and give more than I ever take. So, alright guys, that's all for today's video. Remember to continually work to become the best version of yourself. And we'll see you in the next one. Peace!